Hey guys, Danny here again, owner of the channel DMF Finance. So quick thing, I wanted to talk about DCA, and I mentioned it a little bit in the last video, barely if anything. So DCAing in the stock market, is dollar cost averaging. You could dollar cost average up, you could dollar cost average down, right? So to dollar cost average down is, for instance, you buy a stock at $7.50, right? And you buy, let's say, 10 shares, right? 10 shares. So that's $75.50 if I remember correctly, or $77.50 you spent on the share, just to go all about it. Basically, say for instance the stock drops by let's say $3, right? So then you would buy the stock, you would buy more of it at that price. Now, it's not always recommended to buy immediately after a dip to DCA down, but it can good because your overall payment on that section of your portfolio will go down, and for when the stock go up, you'll have greater returns. But so if you DCA down from, like, let's say $7.50 you bought the stock at, right? And then it drops, and you think the stock is going to go back up, or you feel like you know the stock is going to go back up, which stock market is speculation. So please always remember that. It always swings up and down. It's very volatile. So say, for instance, the stock drops down to $6, but you want more of the stock. That is a good time to dollar cost average down. And then usually the dollar cost average down is, say for instance you bought another 10 shares at $60. So roughly your dollar cost average price would be somewhere in between the high of when you bought it, which would be $7.50, and the low of when you bought it, which is $6. So your overall price for the stock changes, and sometimes it updates immediately, sometimes it takes a couple days to update depending on your portfolio, I believe, or the statistics have to be put in for the numbers to change, right? The other thing you can do, which isn't always recommended, but sometimes it's gonna have to happen, is you dollar cost average up. Dollar cost average up when it's a stock it's been growing for years, and you get in at a certain price and there's no real window for it to go down. Like, say for instance you bought something at the bottom is the lowest the stock has been, or close to the lowest the stock has been in X amount of time that you have bought it. So when it goes up, and it keeps going up and it keeps rising, and it doesn't drop any time in the foreseeable future, or any time of the time you want to buy in, you would have to dollar cost average up if you want to keep buying the stock. That's common as well. I try not to do it too much, but a lot of the stocks that I bought, like for instance I own a few shares of Apple, and I bought Apple when it split. When did it split? I don't even remember when it split, I'm sorry, but I bought it when it split, and the day or two after it split it was at $115, right? And now I have, 1 second, I would have to dollar cost average up. But just to give you the quick number of the price Apple is at now, I think it's around $149, $150. In order for me to buy more shares of Apple, I would have to dollar cost average up. 1 second. So let's use Apple as an example. Yes, Apple is at 150.70 as of yesterday when the market closed at 4 o'clock, I believe. So for instance, just to show, let's see, is it on here? Just to give you, so cost basis. If you look at cost basis, and this is Apple right here, I bought it at $113.88. And since I bought in, I haven't been down. If you want to go off a percentage, I'm up 32.34% on Apple. Now, if I would have bought more Apple back then, I would have had a bigger rate of return. So that's an instance of me. I'm gonna have to dollar cost average up. So for instance, a good dollar cost average down would be, I have NIO, which is the EV company from China. So I bought in pretty on the high ball. I've dollar cost average down a little bit. I originally bought in around $36.10, but if you look right here, and it's probably reversed, it's $34.96. My dollar cost average down a little bit, but currently the stock is at $20.15 as of the market closing yesterday. So with that being said, for me to lower my overall amount spent on NIO and lower my overall losses on NIO, I would have to buy into it more, buy more shares of the company. I definitely plan to buy more shares of the company. I've just been buying shares of other stuff, dollar cost averaging down, and a lot of my, like I said before, dividend investment portfolio. I have kind of two portfolios on there. Well, it's one, my main dividend, that's fidelity.com. I mainly have my dividend portfolio on there, and it's as a cash flow portfolio. Is cash. I don't really do margin anymore because I don't like using other people's money. I'd rather use mine's. So another one, just for another example, is for my dividend, BGS Foods. It's a whole food selling company, right? So let's go to my overall. I have 50 shares at $950.66, right? I'm down 35, basically you could say 35%, 34.46%. I'm negative 500 on the price I originally bought it at. The price I originally bought it at was $28.99, and it's currently at $19. So I'm definitely with that one, and it's a great paying dividend stock. Let me show you the dividends real quick. So remember what I said, a dividend is paid out quarterly, annually, and or it could be monthly. Some pay monthly. A lot of high yielders pay monthly, but we'll talk about why you have to really look at high yielding stocks later. But so the dividend on this, if you look at dividend rate, it's 47 cents, or you can say 47.5 cents. I don't know how they get a 0.5, but 47.5 cents, right? And I have 50 shares. So if you do the math, 0.475 times 50, I'm getting $23 every dividend rate, and they pay out every 3 months, so every quarter, right? And $23, which means the next time I get paid out on their stock, since I said it's $19, it will buy me a share. That's the power of compound interest. My goal is to get to 100 in all my dividends. My short-term goal is to get to 100 in all my dividend stocks, which I have about 32. A lot of people don't do solo picks. I do solo picks a lot. My goal is like 35 dividend stocks, and then just keep adding in and keep throwing money at those specific stocks and not worry about anything else. I did explain I have ETFs that I plan to invest in on M1 Finance that I haven't yet officially yet, because I have to put $100 flat to switch from my spend over to my M1 Finance, because it's on the spend account. M1 Finance Gateway, you have to deposit $100 in total to be able to put it into your ETFs, so, or your stocks. And M1 Finance is good because it sets it up like a pie, and it weighs out the percentage and tells you what is this, that, and a third of your portfolio. I'll show that later on. But yeah, that's why you should dollar cost average down. Basically, anytime you want to drop your overall percentage and price of a stock, it's good to dollar cost average down, especially in the market we're in right now, which is very bearish. But I mean, I don't feel like I'm down too bad. I mean, for these last 2 weeks since the not the what is the CPI came out, I'm down about $1,000, but that's perfectly fine. I mean, COVID, I was down a lot more, and I went back up. Like I said, my portfolio isn't super big, so it doesn't scare me as much as people with bigger portfolios. But I also learned that the best time to buy is a red market, especially when you want a dollar cost average down. I'll probably be dollar cost averaging down even stronger, depending on what the Feds say soon. If they speak and the market is going down further, then I will definitely dollar cost average down. I'll probably throw a little bit more money at it, between managing just regular life and my market account. I try not to look at it a lot, but nowhere near as much as I did in the beginning. If you get that, like, once you get used to looking at loss, you enjoy the green, and you also know and get to the mind state that you should buy when it's red. A lot of people see red and they run from it, but when you see red, like when you're at a red light, you stop and you think, should I go past this red light? Should I not? I'm joking. But you see it to sit there, you get time to think. When you look at your market and it's in the red, it's time to buy. You go green when the market is red, and you sell when the market is green. So that's all I really got for today. Thank you for the video. Please like, comment, and subscribe. Have a good day, brothers and sisters. Stay blessed.